Let's look at amortization, which is very similar to depreciation. You're doing a systematic and rational allocation. In this case, you're doing it of a premium or discount on a bond. And the authoritative source for this is Financial Accounting Concepts number 6. I've copied this, paragraphs 142 and 149 from the FASB website. And let's take a look and see how we practically do this work. And here's our spreadsheet. This is available on Google Docs. And I'll give you a link for that, but we're extending the Lizzie Incorporated case study that we've been working on since Chapter 2. So here we've modified journal entry number 3 from July 1st. This used to be a note, a 2-year note that Lizzie issued. In this case now we've changed it to a bond payable. And this is an IOU that Lizzie created. She went to the money markets to sell it. She printed on the face of her bond that it's going to pay a 10% annual coupon rate. But she was very lucky when she went to the market. The market liked her IOU, and they're going to charge her a little bit less. So they priced this bond to yield at 8%. So her piece of paper that says $20,000, she actually received $22,684 for it, and that gives us a premium of this bond payable of $2,684. Notice that her bond payable account is $20,000. That's the face amount of the IOU. In 10 years, when she pays this bond back, they're going to give her back that piece of paper, and Lizzie Inc. is going to write a check for $20,000 to purchase back that bond in 10 years. So we're going to be working with the accrual calculations tab and the amortization tab, and also the statement of cash flows tab, because we're going to look and see how issuing bonds affects the statement of cash flows, which is a source of cash from financing when the bond is issued. When the bond is paid off, of course, that's going to be using cash. So let's go to the amortization tab. And here we have the date of purchase, which is July 1, 2010, the face amount of the bond. And I've allowed you to change this, and it'll change the amortization schedules. But keep in mind, this spreadsheet isn't bulletproof. You can goof it up if you change the wrong item. But I want you to be comfortable, play with this. You can always download it from Google Docs. Make your own amortization schedules, see how the journal entries flow from the amortization schedules. Here the term is 10 years, and the coupon rate is 10% with the interest payable annually. That means that the coupon amount of $2,000, which is 10% of $20,000, is paid every year on July 1st. So we go down to the amortization schedule, and you see on July 1st, 2011, there's going to be a payment of $2,000. Same thing on 2012, so on through July 1st of 2020, the 10 years. So we're going to actually price this bond 3 different methods. We're going to price it to yield 8%. We're going to price it to yield 10%, which is the same as the face amount on the IOU, and price it to yield 12%. So although we're presenting all 3 in this lecture, we're only going to be using and doing the journal entries in the Lizzie Incorporated case for the bonds that were sold at a premium. They're priced to yield 8%. But I'd like for you to practice with all 3. And what we're using in order to price these bonds and come up with the effective interest rate yield is I put on the spreadsheet a link to a present value of an annuity and present value schedules that are just available. This retailinvestor.org was nice enough to post some time value of money tables. If you know how to use your financial calculator, you should be able to do this yourself and get more precise if you don't end up at exactly an even percent. But generally in your financial accounting class in school, they're going to have you price the bonds to yield at nice even numbers, and you can use the tables that are presented in the books. So let's see, what is this bond? Well, let's think of it as a cash flow, and there's 2 different cash flows. So Lizzie Incorporated sells the IOU, and what she's promising is that IOU, I'm going to pay you $2,000 a year for 10 years, so there's going to be 10 payments of $2,000. That's an annuity. And there's a terminal payment, the $20,000 that is due in 10 years. So the present value of that terminal payment we get from the present value schedule, and the present value of the annuity we get from the present value of an annuity table. You notice if the interest rate were 0, the present value of the annuity would be 10 years. But since there's an interest rate on this, 8% that we used, it's going to be less. So we calculate the present value, and I'm going to give you a link to a time value of money lecture that will help you review this material if you haven't done it in a while. And that gives us the present value using an 8% discount rate of $22,684. This is what the person bought Lizzie Incorporated's bond for. So that was the cash she received, which gives the premium at July 1st of 2010 of $2,684. That's going to be a credit balance. The carrying amount of the bond then is the $20,000 plus the premium for a total carrying amount of the bonds of $22,684. And what you'll see in the general ledger is the two different accounts, one for the bond payable and one for the premium. And at July 1st of 2010, the balance would be $22,684. So let's go on down the amortization schedule. We prepared this for all 10 years. We're using the effective interest method. Some financial accounting books show this amortization of the $2,684 spread evenly over 10 years. So $268.40 a year. That's not GAAP, not generally accepted accounting principles. So we're going to teach you the right way, the GAAP method, which is effective interest method. And I put up here the calculation. All you're doing is you're taking the carrying amount from the beginning of the year and you're multiplying that by the effective interest rate of 8%. That gives you interest expense of $1,815. The difference between that and what is being paid of $2,000 in interest is how much you're amortizing the premium for. And that reduces the balance in the bond premium account, gives you a new carrying amount. Let's go over to the general journal and take a look at December 31st. And you can see the first journal entry that we make. We didn't actually pay anything at December 31st, but we had to accrue the interest. So the amount of interest payable, and I could have put this as an interest payable account, but I just put it in accounts payable because I already had the account set up, is 1/2 of the $2,000 coupon payment. The interest expense then is 1/2 of that $1,815, I've rounded, that would be recorded in year 1 through July 1st of 2011. Well, since we are only doing half the year, I took half of this amount. And since we're using annual compounding, we didn't break our schedule down into 6-month periods. We used just 1-year periods, so we just took half of that amount. So the difference between the interest expense, which is 1/2 of the interest calculated in the amortization schedule, and the interest that's payable, 1/2 of the $2,000 coupon payment, is the premium on the bond payable. That is going to reduce the credit balance that we established up here in the bond payable account. And if we look over on our trial balance, the premium in bond payable went down. It's now $2,591 at year end. Bond payable remains $20,000, and our balance sheet shows net bond payable of the carrying amount of $22,591. So we always have to keep in mind what is that carrying amount. We had to adjust it for December 31st. This is the carrying amount as of July 1st. That's a very common academic trick. We're going to make you understand periodicity and apply your tables that you're calculating for depreciation and amortization. Adjust those for calendar year ends or fiscal year ends. So in year 2, July 1st, 2012, we're going to take the beginning amount, the $22,499 as of July 1st of 2011, multiply that by 8%. That's going to give us interest rate for the period of $1,800. Difference between that and the coupon amount of $2,000 is our amortization of the premium through July 1st of 2012. Next, let's look at two additional scenarios. First is we priced this bond to yield 10%. So this is priced at par. So using 10%, which is the same amount of the coupon, gives us a present value of the bond of $20,000. So if the interest rate, the effective interest rate, matches the coupon rate, then you're going to be selling the bond at par. In that case, you notice that the interest expense is the exact same amount as the coupon amount. So there's no amortization of premium or discount. The carrying amount of the bond then is always the face amount, the $20,000. And last scenario we're looking at is a case where Lizzie's IOU wasn't as couldn't get any interest at its face amount of $20,000. She had to sell it for less than the face amount. She sold it for $17,740. Well, that denotes an effective interest rate of 12%. So this is with a discount. The discount, which is going to be a debit balance, is actually going to reduce the carrying amount of the bond, and that's going to have to be amortized using the effective interest method over time, over the 10-year period. We're using the same methodology. We're taking, for July 1st of 2011, we're taking the $17,740 multiplied by 12%, the effective interest rate. That gives us our interest expense. We subtract from that the amount of the coupon amount, which is $2,000, and that is the amortization of the discount, I should say discount, not premium, of the bond. And let's change that real quick. Discount, because this was sold at a discount. Amortization of bond discount. So let's go back to our general journal, and we see that on December 31st we recognized the interest expense. I pushed that forward a little bit, and let's go through to January 1st, scenario A. What would happen if we bought back this bond on January 1st? So we still owed $1,000 in interest, half of the coupon amount. We would completely reduce the premium balance on the bond discount, on the bond payable, and we would reduce the amount of the bond payable that's on the books. Let's say that we settled this bond for $18,000 in cash. This is a scenario that's on January 11. So we didn't, January 1st, 2011, this is not reflected in the financial statements. This would give us a gain on the settlement of this bond payable of $5,591. If we paid more than the carrying amount of these bonds as of January 1, 2011, there would have been a loss. So keep in mind, we can have a gain or a loss on settling a liability, just like we did on the Lizzie Incorporated example, where we had a gain or a loss on the disposal of some equipment. It works exactly the same way. You reduce you zero out the balances in the bond payable and the premium or the discount, and the difference between that and what you paid to settle the bond is your gain or loss. I also pushed forward scenario B. This isn't reflected in, this doesn't take into consideration scenario A. This is what would we need to record for interest expense for July 2011. It was the other half of the interest expense. The amount of cash that was paid on July 1st of 2011 was the coupon amount. We had previously set up an accrual for $1,000 of the coupon amount back in 2010, December 31st of 2010. We paid the $2,000. The difference between these is the premium on bond payable, the amortization that's recorded for the second half of year one of amortization, which fell over a calendar year. And then I went through and recorded scenario C of recording the interest expense for the first half of year two, or the amortization schedule, which is going to get recorded in the second half of the 2011 calendar year. Take a look at this, practice it. It's very, very common that we're going to make you adapt your amortization schedule to the calendar year. And I put in the accrual calculations. You can see the actual calculation of interest that is recorded. There's the $907 for the first half of 2011, which I got by taking my amortization schedule and multiplying that by 50%. I rounded. I took half a dollar more in the first half of the year and the second half of the year. So I want you to practice all three different scenarios: a bond priced at a discount, a bond priced at a premium, and a bond sold at face amount. Also practice selling these bonds, settling them, seeing if there's a gain or a loss. Last thing I want to do is I want to take a real quick look at how this is affected on the statement of cash flows. We're looking at the cash flow worksheet for Lizzie Inc. And I'm over here to the net bonds payable. You notice the change from the beginning to the end of the year was the beginning of the year was 0. The end of the year was the net amount of $22,591. Well, that was reflected because she sold the bond. Lizzie Inc. sold the bond for $22,684. That provided cash from financing, and the amortization of the premium in year one actually generated cash, because we showed this as increasing interest expense, but it didn't actually increase the amount of interest that was paid. So this is going to be added back. I said that backwards. I'm sorry. It's going to be deducted from the interest expense for the year, because it was actually the interest expense recorded, as we saw in the amortization schedule, was a little bit less than the amount of the coupon payment, the cash that was paid. So that gets adjusted here in amortization. The actual statement of cash flows is here, so you can see the amortization and depreciation. We had the depreciation from the fixed asset reduced for the amortization of the premium, and the cash provided by financing. Included in that is the bond that was sold of $22,684. So this is the financial accounting for amortization. Practice these different methodologies. Work with this spreadsheet. Make sure to work with your periodicity, that you're adapting your amortization schedules for different year ends. But don't chintz out. Don't cheap out and start trying to calculate. If they ask you, what is your net carrying amount in year 3 or year 4, if you've created your amortization schedule, that's a very, very simple thing to do. Find your appropriate item on your amortization schedule. But if you've done this back of the envelope calculation, you're more likely to make an error. So lay things out in a nice, neat, and orderly schedule, and I promise you that you're going to get an A in this section. Make sure you've memorized, you understand your basic accounting from chapters 1 through 5, and I think you'll find that this is a pretty simple topic for you. So good luck, study hard. See you in the free financial accounting textbook, and see you in Google Docs.